Mr. Richard S. Berg will be our next witness. He's the President and Chief Executive Officer of Performance Trust Capital Partners, LLC. Mr. Berg.
Thank you, Chairman Frank, Ranking Member Backus, members of the committee, for inviting me to speak today. My name is Richard Berg. I'm the CEO of Performance Trust Capital Partners. We're a broker-dealer specializing in evaluating the risk-rewards of fixed-income cash flows, including mortgage-backed securities. Our customer base consists of community banks throughout the U.S. who also lend. My written testimony obviously is beyond the 5-minute span, so I'm going to summarize it in the following points, and really was interested in the discussion on the securitization market that no longer exists, because I will address that in this. Here's question number one. What is the definition of a toxic asset? We're spending trillions. We ought to know what that is. Number two, what makes an asset toxic? Number three, what are the automatic ramifications once an asset is considered toxic? Number four, are there assets called toxic that should not be called toxic? And number five, what can be done to detoxify assets? One of the keys to understanding the toxic problem can be found in recognizing how the use of letter ratings, hard-coded into investment policies, regulations, collateral agreements, counterparty agreements, can become an automatic mechanism for labeling assets as toxic. For regulated institutions like banks, insurance companies, toxic assets are typically identified by the credit ratings provided by the rating agencies. As you may know, the rating agency scale typically goes from AAA to AA to single A to triple B to double B to single B, all the way down to the letter D. Most regulations for financial institutions and insurance companies set triple B as the lowest rung for investment grade. Corporate bonds below investment grade are called junk. Mortgages and other structured product below investment grade are called toxic. Let me give you a simplified example. Consider in 2006 that a lender sold 1,000 loans to good creditworthy borrowers, and those loans were then sold in the marketplace packaged into a mortgage-backed security. Let's say that there was a AAA tranche created off that mortgage-backed security. 3 years later, in 2009, the housing market's deteriorated, the economy's deteriorated, and more people are delinquent than were originally expected. Let's suppose, for the sake of argument, that we know enough loans will go bad so the investor of this AAA security will not receive the full 100%, but will receive 99% of the contractual cash flows. The impact on the yield to the organization or the institution is minimal, maybe going from 6% down to 5.95%. I believe everybody in this room would agree that while this is not perfect, this asset is clearly not toxic, but rather remains a high-quality one. I'm not sure that everyone in this room is aware that this security, because it's expected to not receive 100% of its contractual cash flow, but 99%, would be rated triple C. Stated another way, 100% of this asset, backed by thousands of individual loans, is considered toxic because of a very small percentage of loans in defaults. Now that the security is well below investment grade, what are the automatic ramifications hard-coded into policies, accounting, collateral agreements, and regulatory standing, like the system? Well, your capital goes down. There are few buyers of triple C assets, so market prices go down. You have an increase in troubled assets. You're becoming a troubled bank. OTTI says you have an impairment problem. We're going to mark to market. Counterparty agreements are problematic. You have liquidity problems. You have ineligible collateral. You have more liquidity problems. So what is the result of this? You are not going to have a lot of lending, and you have a frozen securitization market. In essence, this security went from a AAA, high-quality, liquid, pledgeable security to 100% highly speculative, very illiquid, non-pledgeable security because of a triple C rating based on an expected 1% loss in cash flow. Although the economic difference between getting 100% of cash flows and 99% is insignificant, the ramifications to a financial institution is devastating, because in most cases the letter rating is hard-coded into all the rules. and below investment grade becomes a cliff event. For decades, letter ratings made sense because all issuers were single obligor issuers. And the rating tried to describe the probability of default because default was either 0 or 100%. For a multiple obligor-backed security, like most of the securities backed by loans, the letter scale makes no sense. We know there will be defaults. The question is, how many? The rating scale for multiple obligor assets should be numerically based. Because so many existing policies, agreements, collateral agreements, regulation, accounting is hard-coded into these letter ratings, billions, if not trillions, of multiple obligor securities are now considered toxic because they're simply below investment grade, even though many of them will actually incur minimal loss. We need to change the letter ratings for multiple obligor securities immediately to a numerically based rating system to more accurately reflect the structure and the risk of multiple obligor securities. Thank you in this late moment for allowing me to present my opinions.
Thank you, Mr. Berg. Really appreciate your testimony. And Mr. Polikoff, I'm glad that you're still here to listen to this, and I hope that when you leave today you'll share with Mr. Long and Mr. Croker, Governor Duke and Mr. Grunberger what you're hearing, because this is what we're hearing all the time. And it is with justification that we're concerned about the actions that are being taken on behalf of the regulators that are just contracting credit at a tremendous rate. We're pouring money in at the top, and it's being, it evaporates at the bottom.